With Wall Street dominated by a handful of stocks, how can investors find value? Welcome to Market Insight. I'm David Pollard. The S&P 500 has retreated from its records, but despite that, 10 stocks accounted for 98% of the market's return this year, according to data provided to us by Morningstar. So in this environment, how can investors find opportunity? Well, let's ask Morningstar's Chief US Strategist, David Sekera. Welcome, David. Many thanks for joining us today. First, in your notes, you say investors need to take a contrarian approach and look at what you call the 3 U's. What does that mean, and why should investors track them?
Oh, exactly. So really, when I look at our valuations, what they're telling me is that what's worked for the past 1.5 years is probably not going to be what works going forward. So just as a little bit of background, coming into 2023, when I look at the Magnificent 7 stocks, 6 of those were rated either 4 stars or 5 stars, meaning we thought that they were undervalued to significantly undervalued. They've all now run up to the point where 5 of them are now trading in fair value territory, 1 is undervalued, and 1 is now overvalued. And as you mentioned, the market is still very concentrated, and when we look at those top 10 stocks, half of them are 3 stars, and the other half are actually 2 stars, meaning we think that they've run up too far at this point. And then when I look at like the obvious AI plays, they're all either at fair value or overvalued. So I do think investors really should start looking more for contrarian plays, specifically looking at what we're calling the 3 U's. Those stocks that have underperformed and are unloved, and of course, most importantly, undervalued.
Well, on that basis, you've highlighted certain sectors you think should be looked at: basic materials, real estate, utilities and energy. Let's focus on materials, particularly gold miners. Gold is at record highs. Miners have also risen in tandem. So is it rather too late to buy those stocks?
I don't think so. In fact, if you look at like the GDX, I think that's only up slightly under 5% year to date. Over the past 52 weeks, I think it's actually down 4%. Now, what I really like about the gold miners is we actually have a bearish long-term view on the price of gold itself. In our financial models for the companies we follow, we're only looking at $2,300 an ounce for 2024 through 2026 in our forecast, but then we bring that value down and we look for the spot price of gold over the long term to fall all the way down to $1,780 an ounce. Yet even with that bearish view on the price of gold in and of itself, a couple of different stocks really stand out to us as being undervalued. So the first one I'd highlight is going to be Newmont Mining. It's a 4-star rated stock, trades at a 23% discount to fair value, provides a 2.6% dividend yield. And then Barrick is the other one. That's also a 4-star rated stock, trades at about a 20% discount, 2.3% dividend yield. So in my view, if gold stays here or even moves any higher, I think there's a lot of upside leverage left in these stocks. Worst case scenario, if gold does move back down to our forecast, we still think that you're buying them at a very large margin of safety.
Let's look at real estate. Given the problems with commercial real estate, shouldn't risk-averse investors steer clear of that as well?
Real estate is really probably the most hated asset class on the street, and it's been the most hated asset class, for a while. And I think that negative sentiment is what's really driving the opportunity here. So when you look at the sector overall, it's trading at about a 17% discount to a composite of our fair values. Now, personally, I would still steer clear of urban office space. That is an area that maybe it's undervalued, but I think it can still get even further undervalued before it bottoms out. But specifically, we like a lot of the more defensive real estate plays, and also look for those companies that already have long-term financing in place, and so they won't be as volatile with interest rates, moving up here in the short term. 2 picks I like here are in the healthcare sector. There's Ventas, that's a 5-star rated stock, trades at a 40% discount to our fair value, pays about a 6.6% dividend yield. And then HealthPeak is the other healthcare one that we like. That's also a 5-star rated stock at a 40% discount. And then one other area that we think has some pretty good defensive characteristics is going to be the cell phone towers. So our pick there is Crown Castle, a 4-star rated stock at a 27% discount.
And what about utilities? Again, unloved, but for a reason, perhaps that there's no reasonable rate of return when compared with other sectors.
So utilities trades at about a 5% discount to fair value. Doesn't sound like a lot, but utilities really rarely trade at that much of a discount when you look at how they've traded over the past 14 or 15 years. We think the sector just sold off too much last fall as interest rates were going up. A lot of people do use utilities as a fixed income substitute. And fundamentally, when I talk to our analysts on our team, they just note that the outlook for the utility sector is as good as they think they've ever seen it. We have the transition to renewables, the investment from the government in the electric grid, a lot of investment in infrastructure. So a lot of good growth prospects for that sector. Two stocks that we like here are going to be Entergy. That's a 4-star rated stock that trades at a 13% discount. That's the company that our team thinks just has the best combination of valuation, growth, and yield. And the other one I'll highlight is WEC Energy, another 4-star rated stock at a 15% discount. And that's one where they think that where they operate is in a very supportive regulatory environment and that they have a very strong management team.
Okay, David, we'll leave it there. David Sekera, Chief US Market Strategist at Morningstar. Many thanks for sharing your analysis with us today. And that is your Market Insight. You can watch more videos on Reuters.com.